Good morning, everyone. Greetings. As I'm sure we are all aware, on July 4th, 2025, Congress passed into law the One Big Beautiful Bill Act, sweeping tax legislation that likely impacts us all, with aspects of it taking effect in 2025 and beyond. It is our goal today to inform you all as to its significant elements and to begin to equip you with the tools alongside your professionals to understand and navigate its impact on you, your family, and your business. It is essential that we all collaborate and plan to take advantage of the many opportunities it presents. We have divided our presentation into 4 sections consisting of estate planning and family office, business tax, international tax, and individual tax. Our presenters, who represent deep bench strength, and the entire team at GPKLEG are all well-versed and ready to assist you in achieving your optimum outcome. With that, I would like to introduce our first presenter, Svetlana Pernia, CPA, Director in our Boca Raton office with our Private Client Services team. Take it away, Lana.
Thank you, Stephen, for the introduction. Good morning, everyone. Thank you so much for joining us today. Before we begin, I would like to mention that we will have a Q&A session at the end of the presentation, so please do post your questions to the chat. We will try to address as many of them as we can, and the questions with the highest number of likes will be prioritized. So please do participate. And if we're not able to address some of the questions, please feel free to reach out to the presenters directly. The contact information is provided on the slide deck. We have a lot of information to cover today, so let's begin. Next slide, please. One of the most impactful provisions of the One Big Beautiful Bill Act is the permanent increase of the federal estate and gift tax exemption to $15 million per individual effective January 1st, 2026. This translates to impressive $30 million for a married couple. The generation skip and transfer tax exemption has also been adjusted to align with these new higher thresholds. This means that many more families will be able to pass their wealth to future generations without incurring any estate federal taxes. However, it is important to consider state-level estate and inheritance taxes, as the applicable exclusion amounts may differ from federal levels. So if the estate will not be subject to federal estate tax, they can still be subject to the state-level taxes, and we need to be careful. Due to One Big Beautiful Bill Act, not many estates will be subject to the estate tax. However, estate planning is still very important because it involves a combination of techniques not only designed to minimize or eliminate federal and estate taxes, but also to reduce administration expenses and ensure property is transferred to intended beneficiaries in an orderly manner. Next slide, please. A crucial step in estate planning is classification of an estate as small, mid-sized, or large, which helps determine the appropriate planning alternatives. And the classification is usually based on the applicable exclusion amount, also known as the exemption amount. First, small estate, the combined net worth of a married couple will be below 1 applicable exclusion amount, which is $15 million in 2026. Mid-sized estate will typically have a net worth between 1 and 2 applicable exclusion amounts, which is between $15 and $30 million in 2026. And large estate will have a net worth of more than 2 applicable exclusion amounts, which is $30 million in 2026. As you can see, for small estates and mid-sized estates, which probably will not owe any federal estate taxes, there would be a shift from estate tax planning to income tax planning and utilization of step-up and basis adjustments. For example, using strategies to minimize capital gains taxes for beneficiaries or shift income to lower taxed family members. Next slide, please. A small estate will not be taxable for federal estate tax purposes. Therefore, its focus is on protection of minor children probate avoidance, assets protection, income tax planning, life insurance planning, and making sure that beneficiaries' designations in retirement plans and life insurance plans are correct. Revocable living trust is a very powerful tool which should be used by all estates, regardless of their size, because it provides privacy, it helps to avoid probate delays and expenses, it allows the grantor to control assets while alive and even after death, and it can offer asset protection for beneficiaries in case of divorce, lawsuit, or financial immaturity. Next slide, please. A mid-sized estate is potentially taxable for federal tax purposes, but this tax can be eliminated with proper planning. So the key focus would be on relationship between the unlimited marital deduction and the applicable exclusion amount. Therefore, the use of family trusts, also known as credit shelter trusts, and marital trusts are very common. The purpose of the family trust is utilization of the applicable exclusion amount and removal of future appreciation of assets from the estate of the surviving spouse. The purpose of the marital trust is to remove assets from the first spouse's estate by claiming an unlimited marital deduction for transfers made to the surviving spouse or trust for his or her benefit, and to get the second step upon basis for the assets when he or she passes away. Assets in the marital trust would be includable in the second spouse's estate. In order for the transfer to qualify for the unlimited marital deduction, the surviving spouse must be U.S. citizen. And if it's not the case, then we would recommend the creation of the QDOT, which is a qualified domestic trust, which will ensure that the transfer will qualify for unlimited marital deduction. Another concept that I would like to highlight is portability, which is a transfer of the deceased spouse unused exemption amount to the surviving spouse. This allows the surviving spouse to use their own exclusion plus any unused portion of the deceased spouse's exclusion. However, this transfer is not automatic, and the election should be made on the estate tax return of the first spouse who passes away. Lifetime gifts can also offer significant tax advantages, especially when they're done consistently. Generally, they qualify for an annual exclusion amount, which is $19,000 per donee in 2025. So therefore, if done consistently, they will allow to remove significant amount of assets and their future appreciation from the donor's estate and shift income to lower bracket donees. And please note that transfers to medical and educational institutions are not subject to gift tax or even gift tax reporting. So therefore, grandparents can make a payment for their grandchildren's private school tuition covering 12 years, and that payment will not be subject to a gift tax. Next slide, please. Planning for large estates typically includes a combination of tax planning vehicles such as trusts and family limited partnerships. Family limited partnerships are typically used to take advantage of the minority interest in marketability discounts, which allow to reduce the value of assets for gift and estate tax purposes. And the use of trusts will depend on the objectives of the family. The one trust I would like to highlight is an intentionally defective grantor trust. This trust is irrevocable for transfer tax purposes, but is treated as a grantor trust for income tax purposes. This means that when assets are transferred to this trust, the future appreciation will be removed from the grantor's estate. However, the grantor will continue to be the owner of the trust for income tax purposes and will be responsible for paying tax on income generated by the trust, which could be another significant benefit of this type of trust, as the tax doesn't diminish the value of the trust, but reduces the grantor's taxable estate. Finally, the grantor of this trust retains certain powers, and one of them is the power to substitute assets, which provides another tax planning opportunity by allowing the grantor to swap the trust assets with low-cost basis for the assets that have the same fair market value, but higher tax basis. And the reason why it's done is to be able to get the step-up on basis to fair market value when the grantor passes away. Next slide, please. All right, let's talk about the effects of the One Big Beautiful Bill Act on family offices. Let's go to the next slide. One of those effects is the enhancements done to Section 1202 qualified small business stock. It's one of the most powerful wealth preservation tools available to high net worth families. And the reason why it's so powerful is because it allows them to exclude significant amounts of capital gains from federal taxation. One Big Beautiful Bill Act introduced tiered exclusion system to qualified stock acquired after July 4th, 2025, which allows 50% exclusion of the gain if the stock is held for more than 3 years, 75% exclusion if the stock is held for 4 years, and 100% exclusion if the stock is held for 5 years or more. Also, One Big Beautiful Bill Act increased the gain exclusion cap from $10 million to the greater of $15 million, and this amount is indexed for inflation beginning in 2026, or 10 times the taxpayer's aggregate adjusted basis in the stock. And this limit is per taxpayer per issuer basis, which is pretty powerful. So if the stock basis is $10 million, then there is a potential gain exclusion amount of $100 million, which is huge. But to make this technique even more powerful, the stock can be transferred by gift or a death to various trusts or individuals, and this will allow each of them to claim their own exclusion. This technique is called stacking. Careful planning must be done in order for this to work, so please do consult your legal advisors to make sure that it's done properly. One Big Beautiful Bill Act also increased aggregate gross asset limit from $50 million to $75 million, and this amount is adjusted for inflation beginning with the 2027 taxable year. The act also included some provisions that can help reduce corporate gross assets, keeping them under the $75 million cap. For example, immediate expensing of domestic research costs under Section 174A and 100% bonus depreciation. We will discuss these provisions later in the presentation. To qualify for qualified small business tax treatment, the entity must be a C corporation. The corporation's assets must be used in an active trade or business other than certain excluded businesses such as professional services, medical, legal, accounting, banking, insurance, investment management, restaurants, hotels, etc. All right, so another provision of the One Big Beautiful Bill Act that affects family offices is a permanent suspension of 2% miscellaneous itemized deductions under Section 67G. So therefore, the investment expenses under Section 212 are no longer deductible, and this is negatively affecting family offices as investment fees are one of their most significant expenses. And solution to this is to organize the family office as an active trade or business, which will allow them to deduct investment fees as business expenses under Section 162. However, again, careful planning must be done in this type of restructuring, and some factors that should be considered are employment of investment professionals, administrative staff, also maintaining independent office space, operational infrastructure, also providing services pursuant to written agreements with clear performance terms, and charging fees that reflect market compensation for similar services. Next slide, please. Okay, in conclusion, we recommend taking the following steps: review of prior estate planning, modifying planning strategies, updating documents accordingly, also use of the increased exemption to transfer assets out and remove the future appreciation from the estate, consider grantor trust asset swap to take advantage of the step-up and basis adjustments, And if a family office has a plan to sell the company, consider entity restructuring to meet qualified small business tax treatment and selling stock over multiple years. Also, consider implementing necessary steps to qualify family office investment fees as trade or business expenses. This concludes my portion of the presentation, and I would like to introduce Stuart Rochatner, partner in our Miami office, who will be discussing the business provisions of the One Big Beautiful Bill Act. Thank you for your time.
Great. Thank you, Lana. Good morning. I'm Stuart Rochatner. Today, I'll be discussing critical business tax planning considerations that have emerged from the One Big Beautiful Bill Act and their implementation timeline. The central theme of our discussion is the interconnected nature of tax provisions and why comprehensive analysis rather than isolated provision planning has been essential for optimal business tax strategy. But first, I would like to just mention a few things about our firm. Two areas where we've been very involved in of late with the crypto and digital asset revolution. We've been handling a lot of state and federal tax audits. I just want to explain that to our listeners. And the other area where we do a ton of work that's interconnected with today's provision is litigation. We do a lot of business litigation, and we also do valuations and appraisals, which could be used for the estate planning that Lana discussed, gifting, business liquidation. So there's a lot of areas, the Section 1202. So keep that in mind. And also, I just want to give a special thank you to Steve Klein, our managing partner, to the other partners for making this possible, and our staff and admin and everybody at GPKLEG that makes our office go every day for client service, which is the ultimate. Okay, so let's get to it. The One Big Beautiful Bill signed, you could see right here, these are all great planning opportunities, but basically transforms business planning with permanent enhancement provisions dealing with asset expensing, bonus depreciation, QBI deduction, R&E business, R&E expenses, qualified business income, opportunity zones, and a list of others. It's really very pro-business and fits in with the goals of the Trump administration to basically help the U.S. economy grow and adopt to changes in the next century. Okay, next slide, please. Next slide. Sure. Okay, so the first area I'd like to discuss, slide before. You go back, Jordan. Okay, so the first area, asset expensing, we sort of touched upon, but you could see here that the government brought back bonus depreciation, where you can, in the first year, write off equipment, vehicles, software, and this is effectively for property placed in service after January 19th, 2025. In the past bill, it was phased out, only 60% or 40%, but now that is a permanent deduction. The other thing is Section 179, you can deduct up to $2.5 million of Section 79 property, which is equipment, vehicles, qualified improvement property, which is interior walls, drywall, lighting, plumbing, electric. So that you could see is up to $2.5 million. And then the third part of this area, which is really incredible, is, you know, many people in real estate, maybe 20–30% of the building will qualify for what we would do as a cost segregation study, and they'll get an immediate write-off. But now if you're building a new building in the United States, construction begins January 19th, 2025 and ends by December 31st. And I believe the building has to be put in service no later than 2030 or 2031. Basically, you can now basically write off the whole manufacturing facility. You're not stuck at the 39% life. So that's incredible that you can almost really, so you can imagine as business investors and real estate owners get more involved, they'll realize you can create a factory. Maybe a lot of it has robotics and employees, and you'll basically almost write off 100%. And the thing to mention here, if anybody has any equipment or purchases or things that they want to get done, you need to do it before 2025, and you get 100% write-off. Next slide, please. Next slide. Sure. This is a really, I really love this provision. This is research and expenditure relief. Um, so right here, starting in the new bill, you can now write off 100% of, I'll just refer to as R&D, but anything that's research and development, it's an immediate write-off. Now, in for 2022 to 2024, if you're a small business and your average gross sales were 31 million and below, you can go back and amend those returns. And if you remember, we used to be able to do NOL carrybacks. So this is really a great provision. We have a current client who still has $2 or $3 million they couldn't write off in those years. We'll go back and get a $400,000 or $500,000 refund. For businesses that are above the 31 million going forward for their unamortized costs, they can elect to choose it over, just write the rest off or do it over 2 years. One of the important things that you could see how this fits in with the Trump administration and their goal is if you have research and expenditures that are foreign, that's still stuck at 15-year amortization. So if you can see on a $15 million of expenditures, you only get 1 million a year. But if it's in the US, you can deduct the whole thing. You can imagine how that creates incentives to help the US economy. And below on the right side, I just basically list out lab materials, testing, supplies, prototypes, engineering, consulting, design fees. These are all things that will play an integral part in the future of the US economy and can be immediately deductible. There also on the key thing to remember here, you have until July of next year to get in your amended returns for 21 to 2024. And one other thing at the bottom, there's different, you can also elect to still do this over 10 or 15 years. Next slide, please. This now becomes permanent. It was scheduled to expire. This is the qualified business income deduction. Basically, the test is if you have whatever your income is, 20% of it can be deducted subject to a test, which is the greater of 50% of W-2 wages or 25% of wages plus 2.5% of a list of certain property. And the entities that qualify are sole proprietorships, S corps, partnerships, LLCs, trusts and estates that have pass-throughs, and LLCs, taxed as partnerships. So basically almost any entity that's not a C corp. The one drawback here is that if you're in a specific business which really deals with reputational skill, which is the professionals, accounting, law, consulting, maybe you're an athlete, sports and consultant, then there's phase out limits around $400,000 or $500,000 where you start to lose that 20% deduction. But the key thing here is to map this out and make sure going forward that the company that you're working with has enough in W-2 wages or property to fully take advantage of the QBI deduction. If the company has $5 million of revenue, you'd like to get $1 million deduction. Next slide, please. Okay, this is also is made permanent. This is really another pro-growth provision. This is called opportunity zones and opportunity zones enhanced. So one of the areas where you were able to sort of roll in capital gains, whether it was short-term or long-term, was into these opportunity zones. What the opportunity zones represent in the prior bill was it was a goal to take blighted economic areas around the cities mostly and give investors the chance to defer capital gains and pour money into these areas with the goal of creating more jobs, more investment in underserved areas. That will now become permanent, and every 10 years it will continue to roll unless it's changed. One of the new enhancements also is that the government wants to actually enhance rural areas. So if you now put the money into a qualified fund in a rural area, which there'll be more regulations coming out on, you now get even a greater step up after 5 years of 30%. But just to give you an example, if you have a $2 million gain and you roll it into an opportunity zone fund, after 5 years, you would get a gain of 200,000 eliminated, but in the rural opportunity zone, 600,000 would be deferred. So there's a $400,000 benefit there. Next, the other thing is the governors will be coming out in 2026 with new opportunity zone tracks. So stay tuned for that. And all the prior opportunity zones will be expired. So this is a few more other business provisions that one should be aware of. There's a provision in there where you're limited on your interest deduction, usually with certain entities that have more than 35% limited partners, believe it or not. But what they did in the new provision, it used to be that your 30% of interest deduction was subject to earnings before interest and dividends. Now that you're allowed to add back depreciation and amortization. So that will give you more room to deduct if somehow you're included in one of these entities at 35% of limited partnership. You can also opt out of this provision and take less depreciation. But it's important that this is mapped out and provision, and we do some mapping to make sure the best thing. Other things to consider, the excess business loss limitation. Historically in this country, you could do NOL carrybacks for 2 or 3 years. Going forward now, you can only take active losses against passive income, and it's limited at 300,000 single or 600 joint. So that's important when you do planning to make sure that you plan out the income and expenses year to year. And a big thing for people in Miami or other cities that build vertical condos, now the new law makes permanent where you can only you only have to recognize the income under the completed contracts for small residential. So that makes, in the old law, you'd sometimes have to pick up a pro rata portion. Now you can pick up the whole thing at the end. Next slide, please. Okay. Really, so the main thing and the theme of the point of the presentation is what I'd like to just demonstrate is, and why it's important to have firms that think out of the box or that are creative. I call these the dynamic duo. One of the nice things that you could do, so if you sell and have a capital gain and go into an opportunity zone, usually after 5 years, you get a step up of 10%. And if you're in a rural, you'll get a step up of 30%. And you have to hold it for 10 years. And that gain that you had from your prior sale is deferred for after 10 years. And if you put the right amount of property in, even more of it could be exempt. But one of the things to do, you could set up a Section 1202 qualified small business entity. And as Lana pointed out, there's different exclusions. But here you can, by using a C Corp and rolling over into a opportunity zone, you can shorten the 100% exemption to 5 years. So next slide, please. Okay, and another dynamic duo opportunity here is basically, again, focusing on their section IRC 1202, qualified small business stock. You could imagine now that with R&E pouring in based on the future of our economy, so you could now go ahead and put money in, get 100% deduction, and then after 5 years, sell your stock with exemption, up to a certain limit. So it's the best of both worlds. Basically, if you go to the next slide. And I just wanted to give you a little example here. You could see that we set up a C corporation that's in robotics or software development, and they spend $3 million. The initial investment was $500,000. They put in $3 million in the first year or two. There's a $600,000 tax savings on the federal side. And after year 3, 4, or 5, and let's say there's exclusions in year 5, you sell for $25 million. You have a $24.5 million gain. That's excluded. And then we've got the deduction. So of savings on the stock. In total, you'd have $3.7 million in tax savings. So that's important. And again, you want to work with a firm that basically thinks out of the box. And next slide, please. And 2 other things, just going back to some of the other stuff before I finish up. What in crypto and what we had when we first had the first bill and during COVID, there were huge gains in crypto stocks. So a quick way to do that is you could roll that into an opportunity zone. So that comes back. And the other thing is crypto is still a security where you can do a short sale, you can take the losses and then buy it back. So those are all sort of dynamic dual planning. Okay, so just to go through again, you want to make sure that you look at the entity that you're operating out of. Does it make sense to be in the LLC or the pass-through where you get a 20% QBI deduction? Or do you want to be in a C Corp and take advantage of the 1202 and a $15 million gain? So basically, you can see there's a lot of planning to do. And one of the things we can offer is modeling. Next slide, please. So just to sort of finish up and give you a few other things, you want to make sure that you get your equipment purchases in by 2025, bonus depreciation. If you have research and expenditure expenses from 2022 to 2024, get those amended returns in by July 4th, 2026. You want to do entity review, pass through versus Section 12. And the manufacturing facility planning is something to consider because you have to have that built by the end of 2029 to take advantage of that 2028. And just again, these are the other things, modeling the 1202, coordinate with the other professionals and prepare for enhanced OZ benefits. And just in summing up, I would just like to say that there's a lot of new stuff that can be done out there through AI, but at the end of the day, you want to make sure that you have a team of accountants, and I think our firm provides that has a lot of imagination, intuition. We work with our clients on an emotional level and use a lot of common sense. So thank you for your time today. And now I'd like to introduce Javier Milo. Javier will present provisions in the international tax section. Thank you, Javier.
Thank you, Stuart, for the introduction. And once again, welcome, everyone. Over the next couple of slides, we'll look at the international tax provisions of this new bill, starting with some modifications to control foreign corporation rules. As we know, a control foreign corporation status is generally dependent on whether U.S. shareholders, each owning at least 10% of the corporation's value or voting power as well, constructively own more than 50% of that corporation. Before 2017, or before TCJA came around, U.S. tax law did not allow for downward attributions of stock from a foreign parent corporation to a subsidiary. This meant that the filing requirement of a U.S. corporation owned 100% by a foreign shareholder was only at the level of the U.S. subsidiary. Meaning, for example, if a client, one of our clients, for example, had a U.S. corporation and that corporation was owned by a foreign corporation, the filing requirement was only at the level of the U.S. corporation. In 2017, TCJA came around and lifted the prohibition on downward attributions, following the same example as before, where we had the U.S. corporation owned 100% by a foreign corporation. A U.S. subsidiary in a foreign parent group was treated as constructively owning the stock in certain foreign subsidiaries of the group, which potentially caused the foreign subs to be treated as CFCs for U.S. tax purposes. Under this new bill, the prohibition on downward attributions are largely restored. So we're going back in time, essentially to the same laws as pre-TCJA. And again, under the same example, a U.S. corporation owned 100% by a foreign parent most likely won't have to include most likely won't have a filing requirement for the foreign subsidiaries of the same group. The filing will stop at the U.S. level. Next slide, please. Additionally, the new bill also expands the scope of inclusion shareholders. Current law, or after TCJA, only those holding shares in a CFC on the last day of the CFC's taxable year were required to include in income their pro rata share of the CFC's GILTI and Part F income. Under this new bill, for taxable years beginning after December 31st, 2025, any 10% shareholder that owns shares in a CFC at any point during the year will generally be considered an inclusion shareholder. And as a result, it will be required to include in income its pro rata share of the CFC's GILTI and Part F income. Note that there is an exemption here for foreign companies that invest in U.S. property. The inclusion will continue to be by the shareholder that owns the shares of that CFC at the end of the CFC's taxable year. Also, the bill makes permanent the look-through rules under Section 954. The rules exclude from income certain dividends, interest, rents, and royalties received by a controlled foreign corporation from a related CFC. Next slide, please. What we know today as GILTI, or Global Intangible Low-Tax Income, has been renamed to Net CFC Tested Income. And under the current legislation, the effective tax rate was scheduled to increase from 10.5% to 13% approximately. Also, the current GILTI calculation allowed for a 50% deduction of the GILTI income and a reduction of 10% return on QBAI, which stands for Qualified Business Asset Investment, and foreign tax credits were subject to a 10% haircut. Under the legislations of the new bill, GILTI deduction, which is now known as the NCTI deduction, it's 40%. And the QBAI reduction, that 10% that was allowed under TCJA, has now been fully eliminated. Altogether, these changes result in an effective tax rate of approximately 12.6%. One thing to note here is that these changes cause the regime to operate more like a global minimum tax, as GILTI now captures all returns, including those from tangible assets. Before it was very tailored to intangibles. So now, as you can see in the name itself, the name or the word intangible has been eliminated. Next, we have our FDII, or what used to be FDII, or Foreign Derived Intangible Income, has now been renamed to FDDEI, or Foreign Derived Deduction Eligible Income. Once again, here the word intangible has been removed, and as a result, this QBAI reduction of that 10%, it has also been removed, same as GILTI, as we saw in the previous slide. So just like a GILTI, again, the 10% QBAI has been eliminated. The new bill also exclude certain income from deductible eligible income. For example, income from the sale or disposition of IP, intellectual property, and depreciable property has now been excluded from the calculation. By doing these changes, the calculation expands the benefits to industries that were previously disadvantaged under the FDII regime, especially to companies operating in asset investment sectors, and asset intensive sectors, I'm sorry. Altogether, these changes result in an effective tax rate of approximately 14%. Next slide, please. Luckily for us, under not a lot of changes under BEAT, or what we know as BEAT, which stands for Base Erosion and Anti-Abuse Tax. The final bill did increase the tax rate from 10 to 10.5%. And one change that it's worth pointing out here is that it permanently excluded the research credit and a portion of the applicable Section 38 credits from reducing the tax liability under the BEAT calculation. But other than that, name stays the same. So easy to remember this one. Next slide, please. Stuart previously touched on this from the domestic side, but essentially another thing that I would like to point out here is that the definition for domestic adjusted taxable income, or ATI, changed. Now it was amended under the new bill to exclude any foreign income. So essentially your subpart F income and your GILTI income will be excluded from the calculation of the calculation of the limitation of 163J on your interest expense, which will result potentially in a higher interest deduction capacity. Next slide, please. Finally, and also Stuart touched on this one from the domestic side, but I would like to point out once again that the foreign research and development expenditures are capitalized and amortized over 15 years versus expensed right away for domestic corporations. And again, this is in alignment with the incentives of this new bill provided to U.S. corporations to bring into the U.S. any manufacturing and development efforts. And it follows the ideology of the current president. And next slide, please. Okay, and this concludes our side of the presentation on international tax provisions. Now I would like to pass it along to my colleague, Jacob Cherling. Jacob is a tax director who is joining us from the Mile High City all the way from Denver, Colorado. So Jacob, take it away, please.
All right, thank you, Javier. Okay, before I get started on my section, I just wanted to remind everyone, if you have any questions, please do use the Q&A function. And if you look in the Q&A function, you should be able to see some of the questions that other people have posted so far. And if you see any that you like and want to make sure that we answer, be sure to hit the like button or the upvote button, because that's how we're going to be sort of deciding which ones we answer at the end of this. All right, next slide, please. All right, So we're going to start off with a broad overview of just how the bill impacts individuals. As you can see from this chart from the Tax Policy Center, most Americans are going to see some level of tax relief, but really it's going to be the high earners who are going to see the largest dollar savings. The key here really is that it's the provisions from the Tax Cuts and Jobs Act back from 2018. They were all set to expire in 2025, and were sort of targeted at the higher earners back then, and those are all now really becoming permanent. Basically, this is going to mean that the tax brackets and a lot of the deductions that we're accustomed to over the last 7 or 8 years are going to stick around and not expire and trigger tax increases that we were anticipating were possible. Additionally, the Yale Budget Lab did an analysis on the bill and noted that while the extension of the provisions could decrease filing time, that the additional provisions that are in this bill outweigh those time savings due to an increase in the record-keeping requirements that are now there, as well as phase-out calculations. So they actually anticipate an increase in the time burden for filing. So bad news for preparers who they're going to take a little longer, and clients as well on that front. We'll also see some additional reporting requirements for employers related to payroll, as some of the deductions and whatnot are related to payroll. It's just going to create an additional challenge and burden there for both employers and payroll companies alike. All right, next slide, please. All right, just some general items just to sort of go through. First and foremost, like I just mentioned, the individual tax brackets that have been around since 2018 are here to stay. So no sudden jumps, they've been made permanent. And while the dollar values in which you hit the tax brackets will adjust for inflation over time, the rates themselves are now permanent. Second, the standard deduction, that was also permanently increased back in 2018. That is now also staying at its higher level. For 2025, it's going to be $31,500 if you're married filing joint. And again, these numbers will be updated for inflation every year. Trump accounts, that is a new one that's going to start being available for people in 2026. Essentially, it's like a Roth IRA for children. It's going to allow non-deductible tax contributions of $5,000 per year for kids every year up until age 17. And then the withdrawals will be tax-free after age 18. They're only tax-free if you use them for qualified purposes such as education, home purchases, starting a business. And if you do withdraw it for any non-qualified purposes, it's going to be treated as ordinary income, and it's going to be subject to a 10% penalty. Unless you hold it until you are 31 years old. After 31, you can withdraw the funds for any reason. It doesn't have to be a qualified reason anymore without paying the 10% penalty. You'll still be subject to ordinary income on the earnings, not the contributions, similar to how an IRA works in that front. Lastly, any children who were born between 2025 and 2028 are going to be eligible for $1,000 of government seed funding when you open the account. The $6,000 deduction for seniors. This is another new deduction. This is for seniors, obviously age 65 and older. It's in addition to your standard deduction. It's going to be a meaningful benefit for some retirees, especially retirees because it's going to start to phase out at over $75,000 for single filers and over $150,000 for joint. So some of the retirees, when they have lower income in those later years, should be able to take this deduction. In addition, all the other personal exemptions that were temporarily eliminated back with the Tax Cuts and Jobs Act are now permanently eliminated. So those are gone for good at this point. Alternative minimum tax, also called AMT, the exemption and threshold amounts for who's going to be subject to AMT were increased back in 2018. Those increases also have become permanent and now are going to be indexed for inflation. So this should help reduce the amount of people that are subject to AMT. And then lastly, I know this was covered a little bit earlier, but I just wanted to sort of reiterate the qualified business income deduction also called Section 199A is permanent and expanded a little bit. So pass-through earners are still going to get that 20% deduction on their pass-through income with all the other limitations and rules have still been in place there, but that should be functioning pretty similarly. All right, next slide, please. Okay. These are just some above the line deductions, meaning that you take them before itemized deductions or standard deductions. So you're able to take these deductions even if you are not itemizing. So some of the highlighted ones here and some of the ones that we've heard a lot about in the press on the bill are the no tax on tips. That's a deduction of up to $25,000 for tips. That limit is the same for both if you are filing individually and joint. It's just a $25,000 limit either way. $12,500 for no tax on overtime. That goes up to $25,000 if you are filing joint. So that one has different levels depending on your filing status. Keep in mind, though, that payroll taxes do still apply for both the employee and the employer. So this deduction is only for federal income tax purposes, not for Social Security and Medicare taxes. Automobile loan interest. This is a new one. It's a deduction for $10,000 on the interest paid on an automobile loan. There's some restrictions here. Essentially, the car has to be purchased after 2024. It has to be an American-made vehicle. The lenders will provide you a statement at the end of the year, similar to your 1098 that you get with your mortgage when you pay the interest there, and it will tell you what the interest that you paid is. Keep in mind also, this is also only for personal vehicles. If it's a business vehicle, it's already going to be deducted on your business returns. So just keep in mind, this is just for personal vehicles as well. All three of these items phase out at higher income, generally around a couple $100,000. It's different for each of them. And they're only scheduled to be around from 2025 to 2028. So there's a chance they could get extended when we get closer to their expiration date. But the way the bill's written and what we currently know is that they will expire after 2028. And the last one up here is the charitable deductions of $1,000 for single filers and $2,000 for joint filers. So this is a deduction that you get even if you're not itemizing. Previously, you would only get to deduct your charitable contributions if you were itemizing, and they put this in there for people who now with this huge standard deduction still get a little bit of benefit from doing a charitable contribution. All right, next slide, please. All right, I just wanted to go through a couple quick examples on this just to sort of show how it would work. So the first one here, no tax on tips. If we assume $130,000 of income and of that $25,000 is tips, and we tell them that they're single and in the 24% marginal tax bracket, basically you could look at the math on the slides, at your own time, because I know these slides will be available. But before, they would have owed about $20,000, $20,462 with the old law. Under the new law, they're going to owe $14,688 on that, which would give them a tax savings of $5,774. So that's a pretty significant tax savings for them. For the charitable contributions deductions, again, if we're assuming single filer with $125,000 of income and made charitable contributions of $3,000, essentially, with the 24% marginal tax bracket, they're going to save $240 because if they're single, they can deduct just $1,000 of that as an above the line deduction. 1,000 times 24%, $240 in tax savings. All right, next slide. All right, so this slide has a bunch of itemized deductions. It also mentions some credits and some other stuff actually as well. We're only going to talk about a few of these things, mostly for time's sake. But there's a couple that I definitely did want to go into here. The first and foremost, the first one on the list there is the SALT cap increase. SALT is state and local taxes. This one got a lot of press and a lot of planning around it back when it was put in place in 2018. Back then, they put in place basically a $10,000 cap on how much you can deduct for state and local taxes that you are paying. The new law increases that from $10,000 to $40,000. So the cap has gone up a pretty significant amount. It's going to allow more people to take advantage of that, more people to be able to itemize, hopefully. It does get phased out for higher incomes, though, and it is scheduled to revert back to $10,000 in 2030. So again, this one's scheduled to be around for the next 5 years and then revert back to $10,000, assuming nothing else changes. Charitable contributions floor. This is another one that's pretty important. They've put in a 0.5% AGI, which is adjusted gross income floor, for charitable contributions. Basically, what that means is whatever your adjusted gross income is, you can only deduct charitable contributions that are in excess of 0.5% of that floor. We're going to go through an example of that on the next slide because I think that it's a little bit easier to see that one with numbers. So we'll circle back to that in a minute here. Another one that sort of got a lot of press and I've heard a lot of people talking about is the wagering loss limitation. So previously, under old laws, you could deduct gambling losses up to 100% of your winnings, meaning, if you made $10,000 in gambling winnings and had $10,000 in gambling losses, you could deduct them all against each other and have zero taxable income. In the new law, they limit the deduction to 90% of winnings. So in that same scenario, you could only deduct $9,000 and you would still pay income tax on $1,000 of income, even though you had no net income in your gambling activity. We're going to run through sort of a very quick example on the next slide for that as well. So we'll see that in a little bit of detail as well. And the other one that I really wanted to point out is the itemized deduction phase out. This is something put in place. It's kind of similar to the old P's limitation, which is why it says P's limitation up there. Basically, once your adjusted gross income goes over $500,000 if you're single, $1 million if you're joint, your itemized deductions start to get reduced. And they can get reduced up to 80%. So you can lose out on a lot of your itemized deductions this way. And you can really be limited in what you're able to do. So it's going to depend on your personal situation. This limitation is going to start in 2026, but it's definitely something for the higher earners to keep in mind and probably try to plan around as much as possible. Some of this other stuff are some tightening measures, some other things that are sort of expansions. The effect of all these will sort of vary taxpayer to taxpayer. And we'll talk about some planning stuff in the last slide in a couple minutes. Next slide, though, please. All right, these are the examples that I mentioned we were going to sort of look at. These are sort of high-level, quick examples here. The first one is with the charitable floor. So basically, if we assume that you have an AGI of $100,000 and you donate $3,000, before you could deduct all of that. No questions, assuming you were itemizing, you could take all $3,000 on your Schedule A, itemize it, and get a deduction for it. With the new law, you would basically have to get over that 0.5% floor. And so you'd only be able to deduct $2,500. And yeah, so it's really going to, if you're at a 22% tax bracket, it's going to probably, you lose about $110 there in tax savings. Gambling loss limitation, again, before, if you had gambling winning and losses of $100,000, you could deduct all of those losses against your winning and have zero income tax. And in the new law, you can only deduct 90%, so you're going to have $10,000 left. If you had a 22% tax bracket, again, that's an extra $2,200 you're paying in income tax when, in theory, you didn't really have any income there. That effect also is going to go into, or that change is also going to go into effect in 2026 as well. Next slide, please. All right, tax credits. So on the tax credits front, one that I wanted to sort of point out in particular is the child tax credit. It's permanently increased up to a $2,200 base amount indexed for inflation, and the refundable portion of that, meaning you get this back even if you have zero income tax liability, is capped now at $1,700. It's a pretty good bump from prior amounts. One thing to note, though, is as with a lot of these things, you now need a Social Security number for claiming it, which most of the time you need a Social Security number to file a tax return anyways, but they've just officially put that in the law just to make it explicit. Some of the other credit information really is that a lot are just being eliminated. Mostly it's things like clean vehicle credits, energy efficient credits, really kind of think of it as most of the green tax credits are going away. So if you were planning on doing anything like this or taking advantage of any of these credits, now is really the time to act because they're going to go away after 2025. Next slide, please. All right, so next steps and sort of planning items. I just want to run through these real fast because I think this is sort of what you should try to take away from this or discuss with your accountants. So sort of for 2025, what can we do before the end of the year? One thing for sure would be to accelerate charitable giving. We have that 0.5% floor coming in next year. So it's going to make sense to maybe bunch multiple years and make a lot of contributions in 2025. It would make sense also to maybe use a donor advised fund to maximize the deduction you receive. And if you don't know what that is, ask one of your accountants, and we should be able to explain it to you as well. But it's basically a fund you can put a lot of money in up front, and then over time figure out where you are going to make those contributions. Consider utilizing the updated SALT deduction cap. Keep in mind, though, this phases out over $500,000 of AGI and is pretty much gone after $600,000. So depending on what your income is, you may or may not be able to take advantage of that. Consider using the auto loan interest as a deduction. Again, it's for personal automobiles, not business, and it's up to $10,000. Maybe try to structure some pay to include tips or overtime, either for you or for your employees if you are an employer. Accelerate those EV and solar purchases because, like I said, those are going to be going away in 2026. And review your health coverage. There's just been some changes in the bill that are going to cause some premiums to increase and some other tax planning that may happen. Especially seniors want to be careful regarding modified AGI increases, which could change them to having higher premiums or getting phased out of the $6,000 senior deduction. It's not the main focus of our presentation, but there were some changes to how all that's working. So I just advise everyone to sort of take a look at that and make sure that they're covered there. And then for 2026 and beyond, estate and gift planning, always important, but even more important right now with all these changes. I know Svetlana covered this pretty in detail, but just a reminder to have everyone keep that in mind. Charitable giving, again, we talked about the floor, but in 2026, coming in with that 0.5% AGI floor. Remember also that non-itemizers in 2026 will also be able to deduct $1,000 or $2,000 of contributions with that above the line deduction. So it may make sense to try to take advantage of that $1,000 to $2,000 one year and then bunch all your contributions the next year when you're itemizing, and then the next year go back and take the standard and take just $2,000 of charitable. So there's a lot of sort of opportunities there to try to min-max your charitable gift giving. AMT planning, we didn't get a ton into it, but just with some of the changes, you just want to make sure to evaluate your AMT exposure when doing any tax planning. It's something that sometimes gets forgotten or overlooked, especially by people who are just sort of doing high-level planning on things. So just keep in mind that is there, and you should always be planning around AMT. And then last but not least, if you can open a Trump account, it may make sense. Again, if your children are born between 2025 and 2028, you get that free $1,000 for them, and you can do this starting July 4th, 2026. Overall, though, as always, I just recommend you speak to your accountant to go over your specific situation so they can tailor the planning best for you. But these are just some general ideas to sort of keep in the back of your mind. I just want to make a couple other minor notes kind of off topic a little bit since I'm sort of done with my side of the presentation, and that is also the end of the normal part of the presentation, but just a couple other things that I was asked to mention. First is that the IRS is no longer accepting or sending paper checks starting on September 30th of this year. So if you are someone who really likes to send paper checks or get paper checks, that option is going away. So keep that in mind. And then for our Florida clients, the sales tax on commercial leases has been repealed, meaning you should not be paying sales tax on commercial leases and you should not be charging sales tax on commercial leases. That goes into effect October 1st of this year. So we can go to the next slide, but that wraps up the individual section. And we're going to be going into the Q&A now. I'm going to be moderating the Q&A. So I'm going to take a look right now at what questions we've posted in the chat and what have the most upvotes and sort of take it from there. So give me a second here while I get that open. All right. The top one that I see here is from Lydia. And it says, if you want to amend to take advantage of the R&D credit, would the new partnership amendment rules apply? This is for Stuart, I believe. So I'm going to let Stuart take this one.
Yeah. Great question, Lydia. I'm assuming you're meaning the amended R&D deduction, but there was a loophole in the old law where if you took an R&D credit, you didn't necessarily have to reduce the amount you were capitalizing as R&E expenses. So now if you want to go back and amend where you're taking the R&E deduction or writing it off, you have to choose to see if keeping the credit or taking the credit and reducing the R&E expense. You can't do both. You have to do one or the other. And in prior returns, we had to you could do to a full credit. So that's what you need to do. But you have to run the numbers in the calculation to see where it's more optimal.
All
Thank you.
right. Thank you, Stuart. All right. The next question that also has the most upvotes here is from an anonymous attendee, but it says, with the new rules around CFCs, does this mean there is no longer a filing requirement for 5471s on these CFCs? That is a Javier question, so I will let him take that one.
Hey, this is Casey Golf too. I'm with Javier, and I can probably help answer this question. That downward attribution change is not going to affect much at all. As part of the 2017 Tax Reform Act, the downward attribution was turned off via a repeal of a certain reg, and it was an unintended turning off that caused the downward attribution. So now they've kind of fixed a problem that was unintentionally created. And just to sum up what it does is it caused a U.S. person who had a CFC, that had a CFC reporting requirement, their ownership was attributed down to the foreign corporation. Then that ownership was attributed back up from the foreign corporation to other U.S. shareholders, not the one who already had the 5471 reporting requirement, but it was attributed to others who did not. And then it pulled them in and caused them to also have a reporting requirement, which was unintended. So it's not really going to have much impact at all. And that was something that a lot of practitioners missed, to be honest, because it's a really convoluted thing that was unintended. So bottom line, it's not really going to impact very many.
All right, thank you, Casey. That was a treat to get Casey on the call. So thank you for joining, and a good answer there. I'm just sort of scrolling through the questions too. There's one that has one less upvote than the highest one, but it's one for me and an easy one. So I'll just take it right now, which is regarding the automobile loan interest deduction. Is it only for new cars? I.e., what if you bought a used 2003 car in July 2025? That is only for new vehicles. You have to be the original use owner of the asset there. So if you do buy a used car, good for the world, maybe good for your wallet, but not good for this deduction. All right, so let's see. The next one up here is, I guess, for Stuart as well. Are there any basis trap avoidance strategies in the OBBBA for real estate held in an S Corp? And this is from Tom's Oats.
Nice question. First of all, you should really avoid almost ever having real estate in an S corporation, but that's another issue. But to your point or your question, I don't think there's anything specific other than there's a ton of, you could see business deductions, whether you're doing cost segregation or asset expensing 179. So without the proper basis, you'll end up maybe spending money on planning or buying stuff that you won't be able to use. Like 179, you can only use to the extent of your profits. So that those are, some traps for the unwary. The other thing is on the flip side, if because you don't have enough basis on a sale of an asset or when you're distributing assets or taking funds out, and that creates a taxable event, maybe you look to take advantage of rolling that gain if it's capital into an opportunity zone or some type of tax deferral strategy. Thank you.
All right, thank you, Stuart. The next question up here says, so most attendees will see some sort of tax savings, however, it might be offset based on the increased time to prepare the return, i.e. more cost to the client. I guess I will tackle that. That's very possibly the case. Accounting and professional fees in general, in especially America right now, are a lot higher than they have been. They're going up year after year for various different reasons. So, with the additional time, it could cost more to have things prepared, and it may offset your tax savings. Again, that's sort of a hard question to answer overall. There's also, changes in the accounting world that help make things more efficient. So even if certain laws make things less efficient, maybe some software and things we can leverage make it more efficient. But again, it's sort of going to be probably on a case-by-case scenario, but that's not necessarily an inaccurate statement there. All right. The next question, this one is for Lana. It says, if you have a small estate and my children are very accomplished and have significant wealth of their own, can the way they inherit my estate affect their estate?
Great question. Thank you so much for this. And yes, if you leave the assets to them outright, those assets would be includable in their estate and potentially would be subject to the estate tax. So instead of leaving the assets outright to your children, consider leaving them in trust for their benefit, where they will have access to income from the trust, but the trust assets will not be includable in their estate. Also, if your estate is not subject to the estate tax, your children may want to consider giving you a general power of appointment over some of their assets. What this will do, this will include the assets in your estate, but they will exclude those assets from their estate. So this is definitely an estate savings opportunity. And don't forget about state income tax consequences. If your children live in the state subject to state income tax, by leaving those assets to them, you may create some additional state income tax liability as well.
All right. Thank you, Lana. All right. The next one up here says, what is the impact of making a 954C6 look-through rules permanent?
Thank you, Jacob. I could take this one. So essentially, the look-through rules were enacted as a temporary provisions, and recently they were extended through December 31st, 2025. This new bill makes them permanent, and essentially, under these rules, a controlled foreign corporation can exclude from its income certain dividends, interest, and rents, and royalties as well, received from a related CFC. So essentially, it's going to have an impact on the total profits being reported.
All right, thank you, Javier. The next one, we're going to stick with you because the next one's for you as well. It says partial CFC ownership means additional reporting requirements for U.S. shareholders? Question mark.
Okay, this is Casey again, still with Javier. It doesn't really change much. That gets back to your categories of filings with CFCs, the 5 categories. And there's always been a requirement when you're category 4, if you hold the CFC stock for a 30-day period during the year. And the category 5 uses the year-end date if you hold the stock at the end of the year. So it's probably not going to mean additional reporting, because if you hold a stock in a controlled foreign corporation and are a category 4 filer, and I won't get into that, you have a reporting requirement if you hold it for 30 days or if you hold it at the end of the year. So it's probably not going to cause additional reporting requirements. Could in very unusual circumstances, but it's still going to be the same reporting requirements. It's just a nuance between the different categories. So it's not going to relieve or increase reporting requirements to any large extent.
All right, sticking with you two. What is the reasoning for BEAT now excluding the R&D credit?
I'll take this one. So essentially, BEAT has always been, or the idea behind BEAT has always been to act as a minimum tax. So by removing the deductibility of research and development credits from the liability calculation, it essentially goes back and looks at BEAT, what it was supposed to be initially, which is a minimum tax. So it's going to act just as that.
All right, thank you. All right, the next question is from Maria Delgadillo, and it says OBBBA lifts downward attribution of stock rules so that means no inclusion of income from a foreign subsidiary in a controlled group, question mark. We had lots of foreign questions. Sticking with you guys.
I believe this is related to the first answer.
Yeah, that's
that Casey answered, right?
Yeah, it's kind of
Gotcha.
the same answer for that. The downward attribution here, again, the bottom line takeaway is it's a little bit of relief that's going to mean reporting is not required when it should never have been required in the first place. It was really a mistake from 2017 that they corrected. So it doesn't substantially change the universe of reporting. It just corrects a mistake that was made.
All right. The next one looks like it's for me here. So let me Take a look. It says for the additional $6,000 for seniors, can you only take it if you are doing the standard deduction and not itemizing? No, you can take it if you are itemizing as well. That is just available for everyone. It works pretty similar to the old personal exemptions we used to have back in the day. All right, the next one is also for me. Are there any income threshold phase outs for the Trump children's accounts? Not that I have seen. I haven't seen that there's any limitations on either the contributions or anything like that. Or when you take it out, I haven't seen anything regarding any phase outs or limitations there. So those should be available for everyone. All right. Why wouldn't the bill add a floor of 0.5% for charitable contributions? Wouldn't the government want to encourage charitable contributions? It seems like the opposite, even though it's a small floor. Long story short, it has to do with the fact that they need to figure out some way to get revenue back. This bill is increasing the debt a ton. And so they're trying to put anything they can in to claw back a little bit of revenue. And this is just sort of one of the ways they chose to do it. I don't know if anybody else has a thought on why they did it, but that sort of was my opinion on why that got put in there. All right. Next one. Any thoughts as to why the government reduced the gambling loss limitation to 90%? Again, they're just trying to claw back revenue. It's a group that they can probably pretty easily do that to without having too much pushback on. It's not a particularly huge lobby. It's a group that they, it's something that's sort of viewed as excess. Not a lot of people, professional gamblers, it's kind of side income. So there's a lot of sort of reasons that they could, and with the expansion of gambling, I think there's a lot of people that think it probably needs more regulation in our country and or taxing on it in general. So I think that they just sort of thought this was one that they could do without, again, trying to claw back some of this increase to the national debt that the bill's creating, and also not have it be something that they're going to get a lot of arguments on. All right, and down to the last one here. It says, did the OBBB change any existing law regarding tax due and owing to the sale of foreign real estate in countries that have tax treaties with the US? So finishing with you guys, Javier and Casey. Maybe. Javier, Casey?
Okay,
Sorry, we were on mute.
Casey, sorry.
No worries.
Not that I'm aware of. Owning sale of foreign real estate in other countries. So a U.S. person selling foreign real estate in foreign countries. No, I don't think that's going to, no change that I'm aware of. And as far as tax treaties go, there haven't been any tax treaties that have been ratified since the Big Beautiful Bill. As always, tax treaty could be ratified and it could change things. If a tax treaty overrules an IRS code section, there is something called a later in time rule that came from the Supreme Court many years ago. And a tax treaty can override whatever is in the U.S. Internal Revenue Code if it was issued later in time, because they're kind of co-equal laws. So if a tax treaty does get ratified that causes something to change along those lines with the U.S. person owning foreign real estate, yes, something could change. But as of now, no.
All right. Thank you. I just wanted to say thank you to the fellow panelists. I'm going to throw it to Steve Klein again. He's going to give some closing remarks. And thank you also to everyone who attended.
Thank you. Thank you to all our presenters. Thank you, Jacob. And just a couple of notes. Our presentation is available on our website. Visit gpkleg.com/OBBBA. Also, an email blast with the link to the presentation will be sent out to our participants. With that, I encourage you to remain actively engaged with your advisors as we navigate these complex waters. Side note, thank you, Casey. Casey Goff works with Javier in our international tax group. As I'm sure most of you are aware, international is very complex and we have a deep knowledge bench there. And in terms of planning and pitfalls and compliance, the complexities are enormous. And so we do have that depth there. And again, Casey, thank you for joining the group. I encourage you to remain actively engaged, as I say, because these are important times. And I think we've stated numerous times that there are time-sensitive and irreversible decisions to be made. So let's just make sure we are all proactive in this process. And with that, I'd like to thank our presenters, those behind the scenes that have helped organize our presentation, and to all of you, mostly, who have taken the time to participate, taken the interest. We're here for you, and this is the time to take advantage of that. And with that, I thank you all.